Here's a split that should get your attention. Freelancers who hold a dedicated emergency fund of at least 6 months of expenses are nearly 3 times less likely to take on high-interest debt during an income gap. That's according to a 2023 Federal Reserve report on the economic well-being of U.S. households. 3 times. Meanwhile, freelancers without that cushion routinely cover dry spells with credit cards, personal loans, or early retirement withdrawals, all of which cost them far more than the gap itself ever did. The standard advice, save 3 to 6 months of expenses, was written for people with a predictable paycheck. You don't have that. So today, we're rebuilding that advice from scratch for the way you actually earn money. By the end of this video, you'll have a specific target, a funding system that works with irregular income, and a place to park every dollar so it's safe, accessible, and actually earning something. Why standard emergency fund advice fails freelancers. Every personal finance article tells you the same thing. Save 3 to 6 months of living expenses. Done. Next topic. That advice was built around a very specific assumption, that your income is stable, monthly, and predictable. Yours is not, and that changes the math in 2 important ways. First, the risk. A W-2 employee who loses their job has a clear income zero date. They know the emergency has started. You don't get that clarity. A slow month might be a blip, or it might be the beginning of a 3-month drought. You often can't tell until you're already in it. That ambiguity means your fund needs to cover more runway, not less. Second, the tax piece. If you're self-employed, you're paying both sides of Social Security and Medicare. That's 15.3% on the first $176,100 of net self-employment income in 2025, according to the IRS. You're also making quarterly estimated tax payments. If income drops and you dip into savings to cover living expenses, you still owe taxes on whatever you earned earlier in the year. Salaried workers don't have that problem. Their employer withholds automatically. You're the employer, the employee, and the accountant, all at once. The right move here is to treat your emergency fund as a business continuity tool, not just a personal safety net. That reframe changes how you size it, how you fund it, and how you protect it. How much you actually need. Freelance math. Here's the number most freelancers get wrong. They calculate their emergency fund based on personal living expenses only. That's incomplete. You need to include your business operating costs too. Software subscriptions, professional liability insurance, any tools or platforms you need to stay operational and hireable. If you go dark professionally during a financial crisis, recovery takes even longer. Here's the formula I'd use. Start with your average monthly personal expenses: housing, food, utilities, transportation, health insurance, debt minimums. Add your average monthly business operating costs. Then add your average monthly self-employment tax obligation. A rough estimate is 25 to 30% of your average monthly net profit, though your specific tax bracket and deductions change that number. Add those 3 together. That's your monthly burn rate. Now, how many months? The right answer depends on your income volatility and client concentration. If 80% of your income comes from one client, your risk profile looks more like a single employer-employee than a diversified freelancer. In that case, aim for 9 months minimum. If you have 5 or more active clients with no single client making up more than 25% of your revenue, 6 months is defensible. If you're newer to freelancing with less than 2 years of income history, build toward 12 months and dial it back once you have a track record. According to the Federal Reserve's 2023 report on the economic well-being of U.S. households, 37% of adults said they would struggle to cover an unexpected $400 expense. For freelancers, that number trends worse. Gig and self-employed workers reported higher rates of income volatility than traditionally employed adults in the same survey. You don't want to be in that group. Calculate your monthly burn rate, multiply by your target month count, and write that number down. That's your finish line. Where to park it? Safety, access, and yield. Once you know your target, the next question is where the money lives. Get this wrong, and you either earn nothing on it or you make it too hard to access when you need it. Both are mistakes. The right answer is a high-yield savings account, specifically one that is FDIC insured, has no withdrawal penalties, and offers a yield that at least partially offsets inflation. As of early 2025, top high-yield savings accounts from online banks were offering yields in the 4.5% to 5% range, according to Bankrate's National Rate Survey. That's materially better than the national average savings rate of around 0.41% at traditional banks. Do not put your emergency fund in a money market mutual fund that requires a brokerage transfer to access. Do not put it in a CD. You'll pay a penalty for early withdrawal, and emergencies don't wait for your CD to mature. And absolutely do not keep it in your checking account. Money in checking gets spent. It needs a separate home with a small psychological barrier, a different bank, a different login, that makes you pause before you touch it. One structure that works well for freelancers: keep your emergency fund at a completely separate online bank from your operating accounts. Transfers take 1 to 2 business days. That's not an obstacle in a real emergency, but it's enough friction to prevent casual raiding during a slow week. Keep the fund in your personal name, not your business entity, unless you have a compelling legal reason to do otherwise. This simplifies access and keeps it outside business liability exposure. I focus on the financial side of freelance and gig work, and this is one of the moves I see make the biggest practical difference: separating your emergency fund from every other account you touch regularly. The variable income funding system. This is where most freelancers give up. They can't figure out how to save a consistent amount when their income jumps from $3,000 one month to $11,000 the next. The solution is to stop saving a fixed dollar amount and start saving a fixed percentage. Here's the system I'd use. Every time a client payment hits your account, move a set percentage to your emergency fund before you do anything else. Pay yourself, pay your taxes, and pay your emergency fund, in that order and simultaneously. Treat it like a line item that comes off the top. What percentage? If you're starting from zero, use 10% of every deposit until you hit your target. If your income is strong and you want to accelerate, push to 15 or 20%. Once the fund is fully funded, drop the percentage to zero and redirect that same habit to retirement or debt payoff. Some months you'll transfer $200. Some months you'll transfer $1,400. That's fine. The percentage stays constant. The dollar amount flexes with your income. This is the core mechanic that makes the whole system work for irregular earners. A practical implementation. Most online banks let you set up automatic transfer rules. But given that freelance payments don't arrive on a predictable schedule, manual transfers on the day a payment arrives are more reliable than scheduled automations. Build a habit, not a system that assumes timing you can't control. One more rule. Do not combine your tax savings account with your emergency fund. These are two separate pools for two separate purposes. Your tax account is a liability, that money isn't yours. Your emergency fund is an asset. Mixing them is a common mistake that leads to underpaying estimated taxes or raiding your emergency fund for April's tax bill. Keep them separated with clear labels and clear rules. According to the Bureau of Labor Statistics, the median weekly earnings for self-employed workers are lower than for wage and salary workers in comparable fields, which means freelancers have less margin for error and more reason to be deliberate about every savings category. Protecting the fund. Once it's built. Getting to your target is one challenge. Not rating it for non-emergencies is another. This is where disciplined systems matter more than motivation. Define what counts as an emergency before you need to make that call under pressure. Here's a tight definition: a necessary expense you could not have predicted and cannot delay without direct financial or health harm. A client payment arriving 2 weeks late is cash flow friction, not an emergency. A broken laptop that stops you from working is a business expense you should have a separate buffer for. A genuine emergency is a medical event, an unexpected legal bill, a major home repair that affects habitability, or a prolonged income drought that exceeds your normal payment delays. Everything else gets funded from other places: your operating buffer, your business savings, or a short-term payment plan. The emergency fund has one job: protect it. The second protection mechanism is replenishment rules. If you ever draw from the fund, that percentage of deposit habit immediately restarts at full rate until the fund is back to target. No exceptions. No, I'll get back to it when things calm down. The month after you use it is exactly when things don't feel calm, and that's when the habit matters most. If your income has seasonal patterns, higher in Q4, slower in Q1, for example, build that into your sizing. If January through March is historically lean, your fund needs to cover that gap without triggering an emergency draw every single year. That's not an emergency, that's a known seasonal pattern. Fund it deliberately. The 1-year milestone and what comes next. Here's what the data shows about timelines. According to a 2024 bank rate survey, 56% of Americans couldn't cover a $1,000 emergency from savings. Most freelancers who start this system from scratch take 9 to 18 months to reach their full target, depending on income level and volatility. That's not a failure timeline, that's a realistic one. At the 12-month mark, or whenever you hit your target, stop and reassess. Has your income grown? Update your monthly burn rate and recalculate the target. Did you add a dependent or significant new expense? Same thing. This isn't a set it and forget it number. It's a living target that reflects your actual life. Once fully funded, the percentage of deposit habit doesn't stop. It redirects. That same 10% can now go toward maxing a SEP IRA or solo 401k, paying down high-interest debt, or building a separate business investment reserve. The habit infrastructure you built to fund the emergency account becomes the engine for every financial goal that follows. The freelancers who get this right aren't the ones with the highest incomes. They're the ones who built a repeatable system early and defended it when it was inconvenient. I'm not a licensed CPA or financial advisor. This is general education for freelancers, not personalized advice. If this was useful, subscribe. There's a lot more where this came from. Drop a comment with the specific freelance finance topic you want me to dig into next. I read them all and build future videos around what you're actually dealing with. Next week, we're getting into something that surprises a lot of gig workers. If you receive tips as part of your self-employment income, the IRS may actually owe you money, up to $25,000. I'll walk through exactly how that works and how to claim it. Don't miss that one.